Hello to you all, wonderful to see you all. I intend to make this session my best one yet. I think you'll find it thoroughly enjoyable. So I really hope you enjoy it too. It's going to be a lot of fun. Last week's homework was what? It was Bollinger Bands. And John sent me an email. He'd put in a huge amount of work into his Bollingers, and because of that I think you'll get the most out of tonight's lesson with the Bollingers as well. So can I have a yes if you built a system with Bollingers, a no if you just didn't try either, and a if you tried but you just found them really hard and not really consistent either way. Right, let's discuss this. This gets fun. I'm going to put some Bollingers on and we'll discuss the different ways we can trade it. So I'm setting Bollinger at default at 14. I might just go 16 if you don't mind, it's basically by default. And I'm going to just expand my upper and lower bands to a bit thicker. And we're going to have a look. And you might want to follow along and do it with your charts too. So this is Euro Japan, 2 and 16, almost default, standard Bollinger. So there's a few ways we can trade this. What's the first way that comes to mind that we can trade the Bollinger? Someone write it in. Right, you guys are too slow. You could pick it in a range bound time and just bounce it from top to bottom, yeah? Now here I am on an FX chart trying to find range bound, which is interesting in itself, but anyway. So you could do this. Okay, now what's the problem with that? Yep, so we could trade off the bands like that. Now who found that's nice in theory, but really hard in practice? Okay, by my mind it's almost impossible to actually write a system that... It's nice to know that theory in all the books and everything on Google's got that. It's nice, but the practice of it is another matter. Okay, key interesting point. You take any indicator and you find out who invented it. And then you do some more research and find out, did he die a rich man or a poor man? Fascinating study. Really interesting. And I'll tell you another thing. Have a look at Gann. For those of you who don't know, he's a classic case of it. People are brilliant at finding that you're very technically minded, but when it comes to being traders, okay, next to useless. Interesting. So with that in mind, it's nice that they've built them and it's nice that lots of people look at them, but we can still on default settings use them in weird and peculiar ways. And I'm a big fan of doing that. Okay, what's another way we can, and we'll lead into that, what's another way we can muck around with this thing? Well, we can use it when it's trending. Here we go. So if it gets stuck on a lower band, we can trade it down. So here it's hitting the lower side, so we may want to keep on trading it down the lower side. We may want to trade it when it comes back to the middle and looks like it's heading on down. Who found that very hard too? Nice in theory, great in theory, but who found that extremely difficult? To actually build a system where when they're fanning out and then heavily trending, to actually build a system that successfully works with that. Okay, so it's really hard. Okay, John put in a lot of work and he's found that his worked. Karen's madly taking notes. Yeah, it's really hard. Okay, so we've got this thing and we've got the theory of how to use it, but in practice it's awfully difficult to use. Well, if we're going to make a trading system with this, it would be really smart of us if we asked ourselves, okay, with this particular indicator that Greg's given us homework to make a trading system out of, what is its independent strength? What is unique about the Bollingers that none of the others have? Now who can tell me, what is it? What do the Bollingers do that none of the others do? Keep in mind that there's dual lines or triple lines. There's quite a bit of that. It's called envelopes, or I don't know, I could look it up. There's a whole list of them. Measure volatility. Look really messy. Expand and contract. Good, Adrian, I can't argue with that. Yep, they are about the only ones that expand and contract. Okay, will you show me another indicator where I can look at number of standard deviations away from the mean? I'm sure you remember about year 9 at school. You learnt this thing called a bell curve, and you could take 100 things and it would fall between that, and that was the first standard deviation, and everything fitted in there. So if you had 100 samples of something, it would fit in the first deviation within the bell curve. Remember this, year 9 at school maths? And then second deviation, that just looked at a little bit more, and I think the second from memory was 98, the first was 95% of what was going on, the second was 98, and then the third deviation was, yeah, you know, almost 100%, 99 or 98, 99 point something. Okay, so the Bollingers are cool because you can say, alright, I want you to look at 95% of price action, or I want you to look at 98% of price action, or 99% of price action. And it gets very exciting because what I want to show you gets deliciously cool. I'll give you a hint. No, I won't yet, actually. We'll go on some more. So I planted that seed. So what's in a way we can take advantage of that? Well, remember I said you look at price action first and the market move first, and then you study the way the indicator has interpreted that. So we can look at this and we can say, okay, I'm on hourly. That's nice and solid according to Greg. I'm on Euro Japan. I'm never normally on that. I don't know, it'll be interesting. And price is moving the way it is. That's nice. Now I'm just going to fiddle with the indicator a bit just to see a few other things. So I'm going to say standard deviation 1. Okay. So that's looking at a lot less. It's only about 95% instead of 98% of price action. Do you see that? Now remember with moving averages you had 20, 50, 100. Well, what if with Bollingers we just looked at something like that as well? So if we looked at sort of around the 20, which is where we are, we're at 16, close enough, say the 50 and the 100 as well, because that's going to look at those time frames that are really important. Now have I lost you? Maybe I have. Remember, why is the 20 significant? Because it's looking at the last 20 hours. If you apply a 20 moving average on hourly, you're looking at the moving average that represents the daily average, even though you're on hourly charts. Well, and then 50 and then 100 is essentially the weekly average while you're on hourly charts. That's why it's so simple and so common, they still stand true. So with the Bollinger, when we look at the length, why not look at that on the average for the day and the average for the week and the average for the half week? So let's just muck around with this one and we'll set it at 50. Now this gets really interesting. Look at that. The way it moves. Okay, so now we're just looking at one standard deviation, and it's just a wide, slow thing, but it's got a few advantages to it still, is the standard deviations and the fact that it expands and contracts, as Adrian pointed out. Okay, so let's study this thing. Now who finds that interesting, looking at it like that? It's one standard deviation, so we only want about 95% of price, and we wanted, even though we're on hourly, we wanted to look at it. That shows us what it's doing for the half week average. And if I set that at 100, it's showing me what it's doing even though I'm looking at hourly, what it's doing for the week, essentially. But I don't want to go look at the week, I want it to be overlaid. So for example, I can set it at 100. Okay, now that's what it's doing for the week. Now, looking at that, I think that's really cool. Can you see some amazing opportunities in that? There's all sorts of opportunities and ways you could trade that. But now we're going to get a little bit creative. So here, what could we do? Well, we could bounce it off the bottom end. We could trade it in a range. But when you actually try and do that, it's still really hard. So it's like, okay, well, we've explored this a little bit. We understand two or three different types of standard deviations, and we understand what it is about the indicator that's unique, but we still can't really put an edge on it. Okay, get this. You're not going to see or learn this anywhere else in the world. Somebody tell me if you have, but I actually thought it up this week and I'm so proud of it, and I built a wonderful trading system with it. But I don't think it's taught anywhere else in the world. We've got our 1 standard deviation and our 2 standard deviations of price. Remember with the 16? Hold on, that just disappeared on me entirely. What if we were to compare, this is where it gets really interesting. What if we were to compare what's going on within the 2 standard deviations of price on the daily and compare that with 1 deviation of price on the mid-weekly? That right there, because what you're doing is you're comparing 1 standard deviation with 2, but you're also doing it on the current day relative to the last 2.5 days. Now you can vary this however you want, but it's wildly powerful. Alright, now who can see, how would I do that? Someone type in and tell me what would we do to begin doing that? It's amazing. Do you see what I'm doing here? Now if I'm losing some of you, that's okay, I expect to. It'll all make sense in a bit. Okay. I've just got some blank faces, so we'll move on. Here's what I'm going to do. I'm going to get this weekly on 1 standard deviation. The reason I'm using that is because I just like the way it moves. And on top of that, we're going to put the other one, we're going to overlay them. 2 and 14. Four and 4. Oh, sorry. Should be a brighter colour. I'll get organised in a minute. Yellow, green. And yellow, green. 3 and 3. Okay, can you see what I've done? I've got 1 standard deviation and 2 standard deviations. I'm comparing daily with mid-weekly. And I've got Bollingers. Now, as you can see, there's lines all over the screen. That's pretty confusing, isn't it? What don't we need? On screen, what don't we need? We've got upper band, mid band, and lower band twice. Which can I switch off? Someone type in and tell me. We need to clean up this screen a bit. Very good. Mid band, don't need it. We'll turn it to transparent. Transparent. Okay, now it's very simple. Now with that, how can you use that to trade? Okay, just looking at that. First of all, who's excited yet? I want to see who's excited. Okay, think guys, think. You're not always going to have me around. How would you use that? Well, hopefully, Jenny, if you all move up to the Sunshine Coast, We can all visit each other on our different acreages and swap veggies from our veggie gardens. Crossover of the bands, yeah. Crossovers, yes, good. Forget bouncing off, forget if they're in a range bound, forget if they're trending. Let's leave that and let's start talking moving average crossovers. But we haven't got moving average crossovers. We've got upper bands, 1 and 2 standard deviation, lower bands, 1 and 2 standard deviation. So what they're set on is daily and mid-weekly. But we're looking at hourly. It gets wicked. It gets really cool. Okay. So if I'm looking at crossovers and I wanted to look at a buy signal, which bands would I look at for the buy signal crossover? Okay, it's nice that we're getting closer to the crossover idea, but what crossing what? I mean, there's a heap of things going on screen. Okay, so for a buy, we'd want the upper bands to cross, and for a sell we'd want the lower bands to cross, and we'd want the faster one to cross above the slower band. So obviously the daily crossing above the mid-weekly. So here is your long. And here would be your short. Now, when it comes back in like this, I don't care. Let me see your view. See that? So the lower one coming back into the range doesn't bother me. But if the lower one leaves, then I am interested. Now, you could say, well, it's left here, so what are you going to do? Alright, well, where's price relative to it all? Okay, a little bit of common sense with this. Now, this is just the beginning. Okay, you can use this alone as a really solid foundation to build some sky rises type trading plans. Amazing cool ideas and concepts. And it's hugely powerful because you're comparing 95% of price action with 98% of price action, you're comparing daily with mid-weekly, but you're doing it in a very sophisticated and suave way. Okay, very cool. Yes, suave is a new word, I just invented it. Alright, let's discuss these breakouts here. For example, that one there, moving on down. Greg, what about that? That opened up to the upside. What would you do about that? Okay, when that did open to the upside, where was the lower one relative to the mid-weekly? It was already outside. Okay, interesting points. Well, what did I deduce from that? Well, let me show you my trading plan now from that. Okay, Euro Japan, hourly, longs and shorts, the two Bollingers, the fast and slows crossing as said for longs and shorts, 90 pip profit, 80 pip stops, a bigger profit than stop, running at 67% success. It's giving 2 trades a week, so for those of you who like lots of trades, it's 2 a week. I think that's, by my terms, that's quite a lot of trades. The profit bigger than stop, if I actually made them more equal, then this would rise. So if you like 70% success, well, with an 80 pip profit, 80 pip stop, you might come in more at about that. I actually wanted a slightly bigger profit to stop. And the test period is a little short, but notice that it's balanced. This is one trading plan going both ways. So when it triggers, I take the longs and I take the shorts. Now your homework, by the way, is to build a system with fresh eyes. I'll come back to that. Please remind me if I forget. Alright, let's see how this thing has performed. Well, I'll just discuss a few examples. Here is an example of a long, and you can see why, because the fast crossed the slow. And you can see an example of the short, the slow crossing first, and it moving on down. And this is your profit line. Now please don't just copy this one. Build your own, but I just want you to get excited by the concept. Jenny says upper and lower at the same time. Okay, let's discuss that. see how this one broke out here, but it didn't trigger, and then here it did. When I write these, I code them in mathematically, so I don't, the human eye, because I don't trust my human eye to make errors, so it has a very mechanical way of taking these. So I'm going to have to check why mathematically it didn't take the top one and it just took the bottom one and rolled on down. Let me go up and check why that would be. I might just see if there's a clue in the rules, otherwise I'll just have to check the maths, but there's absolutely no ambiguity in how it's programmed. Okay, there might have been something else I programmed in there to get around that, but rest assured it is literally as mechanical as that for going up and this for going down. Let me look at why it didn't want to go long there, as I am curious. Okay, moving on. As you can see, it's quite a solid move up with a 90 pip profit, 80 pip stop. So it's pretty exciting. And as I say, the rules are mathematically programmed in, so I can't pick and choose it, and that's what it created, so it's pretty cool. Okay, John says, why is your daily Bollinger Band set at 16 instead of 20, which is the more default? I just have a personal preference for 16 from when I do work with my Bollingers. If you'd like to set it at 20, please do, absolutely. That's just what I like to do. Now, this is the longs and the shorts. It's nice to see a system where the one system has both longs and shorts. You'll see the maximum consistent losers in a row is 3. On the long side, it actually does have 4 in a row, and on the short side, it only has 2 in a row. But because you've got longs and shorts put together, on average it comes out as 3. We've almost got our 70% success, but not quite. But with our profit and stop, you can see that we're making more than double what we're losing to give us a net profit over that time. That is quite healthy. And on average, remember how I was talking about the trades, never mind, don't think of it, let's say trading $1 a pip, don't think of it as plus $85 or down $75, because you'll get pretty flat if you do it like that. Just think of every trade as that's $32, thank you, every time. And as I said, what's fascinating is if you look at the 20 freebies we tweeted out and you add them all together, it comes to, and they're from all different types of trading plans and styles, it comes to about, on average, 32 pips a trade. Some trades are 175 pips, some were minus 80 pips. Spread it out and it comes to about that. So it's interesting that these systems that we build this way, on average out, this is the theory, but in reality it shows through as well. So the Bollinger Band lesson is, sure, use the indicator on default settings, but don't use it the common way. I did actually hint that people who have actually invented the indicators died poor. And if you look into it, you'll find most do. It's because they were excellent at analytical thinking, and I even hinted at Gann. Now you can read up on again. No, Gann did wonderfully well. We'll look into it harder. But absolutely fascinating. If the fellow that invented the thing couldn't figure out how to use it, isn't that interesting? And that was way back in simpler times. So I'm saying use it in a way that's a little bit creative. Okay, who finds that interesting and exciting? Who is lit up by that? Believe me, when you start writing trading plans with that, it is cool. It is seriously cool. Okay, great.
Order pending.
Here we go.
Order pending.
I've got some trades triggering. What am I doing? I'm going long AUD USD. Okay, I'm going to have to Twitter that one out. And what's my profit and stop on it? Sorry traders, I just had a trade trigger. Okay, massive profit and quite a small stop. Alright, I'll get to that. We'll carry on with this lesson. Okay, your homework. Your homework is to build a system with fresh eyes. We've worked our way through, for some of you, coming up to 12 systems. And you can feel, you might have looked at, say, the stochastic or something. You feel, I've looked at the stochastic, I'm done with that, and you move on. And you work your way from system to system to system to system to system. Well, more systems doesn't mean more success. Some companies, and I don't agree with it, they might just be divergence, or they might be just waves. Well, that's not helping you. But look at what you found easiest to put systems together with, and don't think that you're done and finished with it. So what's one that we've done recently? Or it could even be something like parabolic SAR, and you think, I've done it, I've built all the plans I can, I don't want to see it again, I'll maintain what I have built, but no more. What I'm saying is go back and have a look at it again, and you'll be amazed what you came up with. I mean, the amount of work I've done with Bollingers in the past, but this week comparing them that way just excited me so much, and then some of the plans I was able to build from it, amazing. But more to the point, using the top and the bottom to cross over like that is a beginning point. You can then put that together with your other styles or another favorite indicator, and it just tops it off. Or it can be a filter for something else. So maybe you've got a completely different style, and that's nice, but you also just have these two Bollingers, and they are your general bias. So you've got your normal style, maybe it's just MACD, and you get in depending on how your MACD does its thing. But you'll only do it if also the short-term Bollingers are on the lower side of the mid-weekly, and if that's the case, you'll take it. So it's really good. So I want you to look back over all your systems, because this is the lesson I want you to prove to yourself is you've come a long way, and you've worked your way through a lot of different ideas and systems. I want you to go back to the one that you found easiest, put on fresh eyes, which means pretend it's the first time you've ever seen it. Go to a market you haven't built a system on with it. So let's say you take the MACD and you go, alright, I haven't built any systems on Euro Japan with it. I'm going to look at it with fresh eyes and see what I can do. And here's the lesson I want you to get this week from it, is I'll bet you can take that and build your best system yet with it. And that's a really big lesson, because you're like, oh, I'm looking forward to learning something new from Greg, or a new system, and I'm going to create them and layer them like a lasagna, and that's great. And then after you've done them all, well, then you run out of time, and you don't really go back, you just sort of polish the ones you've got. But with this homework, you go back, you find the indicator that you have already done a lot with, you look at it on a new market with fresh eyes, and you build the best system you've built yet. You're like, ooh, I would have never found that unless I'd gone back and done that exercise. Which means, with all the current systems I've got, with slight variations, how much better could my trading plans be again? Because the biggest danger with a trader is just getting more knowledge. Huge danger. Without a doubt, there's one thing I thoroughly enjoy talking about with pro traders, and that is hearing from them when they say, when my trading is going a little bit average, I always resist the urge to go off and learn a new system. Instead, I take stock at all my current knowledge, because I've got a big amount of it now, and I think, with everything I currently know, what can I create that's a great trading plan to go forward and trade? And so with all their current knowledge, they build something better, and they keep going with their trading. Right? They didn't go do another course and learn more. Learning more is not the answer. So get that lesson by finding one of your favorite systems, looking at it with fresh eyes, and building a better system than any that you've built yet. And then you'll see that even with the 12 systems you've got more than enough to keep you happy for years to come. The bottom line is you're focusing on growing your trading account. Don't confuse experience with increasing knowledge. Okay, so is everyone okay with their fresh eyes homework? Yep, good. And can you all appreciate what I'm saying about not ever going on to new systems, new indicators, more knowledge? You all understand now the importance of a solid market move. You totally understand that. You totally understand the directions and the biases of the markets. You understand what to look for with a trading plan in terms of when it seems to be coming to an end, getting a feel for its longevity. And I've made the point many times, we did one exercise where different people gave me different elements of the trading plan, and right in front of you I built a trading plan. So it doesn't matter the indicator or the market. Okay, it's an experience of how the market moves and applying that. Okay, so you got more than enough. Always just use it in new and interesting ways. And a case in point is the Bollinger Band. Who would have ever thought you could use it in such a way as we just have today? Okay, time for our next lesson. I'm busting to tweet her out that trade, but anyway, I'll do it later. Alright, the next thing is, Bob was interested in the maths behind fine-tuning your profit and stop. I went on a big long talk about how at the end of the day it doesn't really matter, and I could actually bring up some of the mathematical systems we use and just change it in a heartbeat, and every 5 seconds show you this is it with a 90 pip profit target, 80 pip, 70 pip, this is with the double or the triple size profit target or a quarter of the size, and you see at the end of the day there's just a certain amount that the market with that type of move is willing to give. Okay, but I want to show it to you in a slow manual way because then you can really understand it. So we'll go into that. Now I'll remind you again, there's 2 levels. The learning's in the doing, there's 2 levels of knowing it. I'm going to keep driving this point home. Everyone was completely aware of the need to use indicators a little differently to everyone else. Everyone was aware of that. I didn't see anyone take the Bollingers and just, on default settings, explore the standard ways of doing it and then think of a completely wacky way of using it. Okay, to its advantage and taking advantage of its strongest points. The fact that it shrinks and grows and that it looks at standard deviations. Right. So everyone knew it, but nobody knew it. Hopefully everyone knows it, and hopefully now everyone really knows it. So hopefully with your indicators now, you really will look at them the standard way, but then think of the unique element of it, and then be pretty wacky with it as well. And I'm going to tell you again next week about those 2 levels with something else. What we're going to discuss now is profits and stops and some of the maths behind deciding what it should be. So let's say we had a particular trading system, and this is, remember the shorthand, and you should be using this shorthand each week. And you're all familiar with the shorthand, so if price does a sweeping move and you work out, okay, if I wanted to get in here on that sweeping move to get that profit, let's say you put 7.75 is how far that profit level went to there. To get that, I would have to withstand 3.75 because price actually dipped down a little bit before it went up. It gave us a little bit of heat. So I'd have to put up with at least or accommodate 3.75 points of heat to get the 7.75. So everyone's familiar with that shorthand and how we do that? Now what I've done is I took a system over 6 months that I quite enjoyed. It was a monkey system, so same time every day. The opportunity was there or it wasn't. On average, I got a trade a week. For 6 months you can see that there's on average 4 trades a month, which makes sense. Some months there's only 1 trade, some months there's 8 trades, so it's going to overall average out. And you can see that I was able to get quite a bit of profit sometimes and a very small amount of profit other times. And you'd look on the left hand side and say, right, that's the maximum amount of profit I can get. So for example, I can get up here 7.5 points, I can get 28 points there, I can get 10 points out of that one. But this one's only got 1.5 points to give. So if I have a 5-point profit, well then I'm going to get quite a few of these, but it's just going to stop out on the 1.5 profit. And then you look at your stop and you say, if I had a 5-point stop, then all of these would be allowed through. So that's fine. But a 5-point stop would be stopped out here because here I needed an 8-point stop. So you look at the profit side, the stop side, and you work it out. So everyone's familiar with that? I'll quickly run through one example. So let's say, for example, now this example is on the E-mini ES. Doesn't hurt to flick between the two. It's good to think with both markets. So if we had a 5-point profit, 5-point stop, I'm saying we'd have 21 out of 28 trades successful, or 75% success. Our profit and stop is equal. Okay, now I'm going to discuss how we'd get that. So 5 and 5, let's go back and see how we come up with that number. So for Greg's trading plan, whatever it is, we're going to run through this together. 5-point profit, 5-point stop. Okay, so I get the first one. It'll be quicker to do is find all the ones we didn't get. If we do that, then we'll just work out the difference. So 5 and 5. With a 5-point profit, 5-point stop, how many stop outs did we get through here? So very first of all, I'm going to be looking for in brackets where it was greater than 5, because that stopped out, it didn't accommodate it. So there's 1. So that's 1. And also, if the profit didn't run at least 5 points, then the profit target was not hit. There's 2, 3, 4, 5, 6, 7. So we've got 7 where it just wouldn't have worked. Now how many trades are there here? There's 28. And 7 didn't. So that's 21 out of 28. So we got 21 wins out of the 28 trades. 7 stopped out with a 5-point profit, 5-point stop. They stopped out for 2 reasons. The stop wasn't big enough sometimes, so it just hit the stop first, or it didn't run. There wasn't a run to profit. There was no profit to have, so that one stopped out as well. Okay, so is everyone understanding how I would say that's 21 out of 28? Does everyone get that? I'd say 21 divided by 28 is 75% success. Now, with 3 contracts at $50 a contract, sorry I'm losing my voice here, then every time we're right, we're making $750, and every time we're wrong, we're losing $750. So if you take all our wins minus our losses, we're overall making $10,000 or $10,500. So that's our starting point, an equal size profit and stop. Now let's explore every other variation you can dream of. And what you'll see when we study every variation is this figure at the end of the 6 months is about the same. And it's very interesting. And it's good if you do this exercise with some of your own trading plans. So that's with an equal size profit and stop. Let's optimize it to make the most amount of money. So we go an 8-point profit, 5-point stop. Our success drops. We would expect that. You should know that by now. That's going to happen. But overall, because your profit target is bigger than your stop, we make a bit more money. I'd call it about the same, but it's slightly more. 12,000 instead of 10,000. Okay, is everyone with me so far? Yep. So we've optimized it. And I want everyone to do that. I'm not just saying, look, give up with what size profit and stop you should use and make them equal. No, don't. Look at what is the best. So here, it would be smart to go, you know what, the best is to have a slightly bigger profit than stop. And that's smart. That's good. Now let's look at some other variations we could make of this. What if we were to have a 4-point profit, 12-point stop? Oh no, Greg, you don't do things like that. Yeah, I agree, but let's just look at it for the sake of the exercise, right? It means your profit target, you're going to get it a lot, because you're not asking the trade to give you too much. And your stop is very accommodating. Okay, the market can fluctuate quite a bit and still generally most of the time hit that profit, and occasionally we will hit the stop, but we'll be able to deal with it. So look at this, 26 out of 28 times. We almost always got it. There was only 2 scenarios where we didn't get our 4 points. We ran at 92% success, so we felt great. When we were right, we made $600. So we're making $600 an awful lot. Bang, 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 yes, thank you, put it in the bank. And very occasionally, we lost $1,800 over this 6-month period. Now, who's starting to find this interesting? small profit, large stop at a ratio of 1 to 3. Look how much after the 6 months that it came to. 12 grand. Hold on a minute, where have you seen 12 grand before? Well, I'll tell you where I've seen it. I worked out what the best size profit and stop is. I had, stereotypically the best, a bigger profit than stop, 8-point profit, 5-point stop. How much did it give me? 12 grand. Okay, if we go up and we go, alright, equal size profit and stop of 5 and 5 before we start doing anything with it, 10 grand, much the same. But the uninformed would say, oh, equal size profit and stop, then all you've got is probabilities, and probabilities have to be good. Bigger profit than stop, oh, that's very good, congratulations. And then they'd say, oh, small profit, big stop, oh, that's to be frowned on. You obviously haven't read enough trading books to know that you don't do something like that. Well, this person with all their opinions, if they crunch the numbers, they'd see that, guess what, the market has a certain amount it's willing to give. And that's the end of it. Interesting, let's keep going. Let's go, that was a 1 to 3 profit to stop. Let's go to a 1 to 2 profit to stop. So we've got a 5 profit, 10 stop. We're running 85% success. We've had 4 stop outs in a row. $750 when we're correct, minus 1,500 when we're not. What did it come to? 12 grand. Same amount of money at the end of the day after 6 months and after 28 trades. It was a particular monkey system. Sometimes I had 1 trade a month, sometimes I had 8 a month. Let's keep going with this. Alright, let's get sophisticated. Let's scale on out. Alright, so what we'll do is we'll have a 4-point profit 10 stop, 5-point profit 10 stop, 6-point profit 10 stop, and while we're driving around town and going out to the shops, we'll be mulling over in our brain all the fantastic reasons why this covers multi-scenario. No longer are we profit and stop, black or white, you win or you lose. Now we've got variations, shades of grey. Excellent. We can accommodate more outcomes. We can have it went a little bit in our favour and we got our 4 points of profit and then it stopped us out, or it might have given us 4 and 5 and then stopped out, but because we were clever with this, we had 4 points of profit plus 5 points of profit, and then if it did turn on us after that, minus 10, because we're plus 9 and then we're minus 10, we're only 1 point down. So brilliant, brilliant. No longer are we a win-loss scenario, we have multiple outcomes. Very exciting. Well, crunch all the numbers, do all the maths. What did we come to? 11,900, basically 12 grand. Oh, okay. Now I'm not saying this is the case with every trading plan, but I want you to have a look at this with some of your trading plans, and it gets rid of a lot of the generalizations, because you've challenged them, you've looked at it yourself mathematically, and it's very interesting. Alright. What about this? What about every time something triggers, we always get a better entry? So, okay, the signal's confirmed, but we're not getting in, not with anything. We're going to wait for it to retrace, and we're going to get a better entry, 3 points better. Now, if it just goes off to hit the profit, well, we just missed it, we missed out. But if it goes against us, gives us some heat, and then we get in, well, then we can benefit. And we'll do that with our usual 3 contracts. Okay, the reason I used 3 is so I can give you examples of breaking it up sometimes and scaling out and all that. Well, we're running at 64% success. We're running at $4,200. But because we're waiting for it to pull back, we're only getting about half the number of trades, or slightly less. See, remember how all my percent successes were out of 28 trades. Now we've only got 14, half. Now guess how much we're making? Remember the original amount was 10 grand and then 12 grand? Well, now we're making about half that, or actually about a third of that. Which makes sense because we're taking about a half the amount of trades. So that doesn't really affect us too much. Alright, what about scaling in? Everyone's heard of scaling out. Have you ever thought about this idea of scaling in? You see, scaling out is as it goes to profit, dropping off bits and pieces. Okay, so it's making more and more profit, the trade's going well, we're dropping off components of it. Now scaling in is as it gives you heat, get in again. As it gives you more heat, get in again. Every time you get in, scaling in, you're in a better scenario because your stop's getting smaller, your profit is getting bigger. Okay, so first of all we get in equal size profit and stop, 5 and 5. If it gives 3 points of heat, then we get in 7 point profit, 7 point stop. But relative to the signal entry point, it only has to make 4 points of profit, and the stop is at a 10 point area, so it's a way better advantage. Now if it gives 6 points of heat, then we have a 12 point profit, 4 point stop. Okay, now from the entry signal, that's where it is relative to the entry signal. Okay, so very exciting. Crunch all the numbers and look at the amount of trades you get, and it's not particularly exciting. So you look at all that, that's just a few examples, but I want to come back to one simple point. An equal profit and stop, or a slightly bigger profit and stop like this, okay, has the best chance of giving you a smooth profit line, which means how it grows and drops is going to be just quite smooth and quite unemotional. Now when you're trading, it's so important to looking after your psychology, to just consistently grow without too many hiccups, and if the trading plan's coming to an end, that it does so gently and it doesn't just turn on you, it just becomes a bit average and then a bit more average, and you think, nah, I'm losing interest in this one. Okay. Now if you're going to do something like that, that size profit and stop, just a slightly bigger size profit to stop, is the easiest to come up with that. Okay, who found that interesting to crunch the numbers again and just to see that? The reason is I don't want people to get all carried away with the size of their profits and stops, but just appreciate that the market, as a trader, you found a market move, an inefficiency, and there's lots of other traders who have found it too. If they hadn't, it wouldn't be there. And they're traders with big money, you're not, because they're able to shift the market every time it happens. And they're only going to shift it a certain way every time, so there's only going to be a certain amount of money in that move to give. So taking that approach with your profit and stop will give you the best chance to get the most out of the signal without getting too carried away with it. Thanks traders, talk soon.